Inflation data came in largely as expected in December, helping stabilize the markets. And at the same time, lower interest rates have begun to translate into increased home sales activity as affordability improves. Good afternoon. We kicked off the year with fresh inflation data last week, and while it came in largely in line with expectations, it did little to clarify the Federal Reserve's next move. Adding to the uncertainty, with the shortened holiday week, it's starting with the 10-year Treasury climbing to around 4.27%, pushing mortgage rate higher than they were a week ago. Now, there's a lot to unpack from last week's activity, so let's dive in. Here are your headlines. Consumer prices rose 0.3% in December at 2.7% year over year, with the annual rate unchanged from the prior report. Core inflation, which excludes food and energy, increased 0.2% for the month and held steady at 2.6% annually, its lowest level since early of 2021. These readings were mostly in line with analysts' expectations. Now, housing costs are still one of the biggest reasons inflation remains elevated. Because shelter makes up a large portion of inflation measurements, even a small increase can have a noticeable impact. In December, housing costs moved slightly higher, which helped push overall inflation up for the month. Remember, the Federal Reserve is trying to balance two competing issues: inflation that hasn't fully cooled and a job market that is starting to slow. Sticky inflation makes the Fed hesitant to cut rates too quickly, while softer employment data increases pressure to provide some relief. The Fed did cut its key rate 3 times by 0.25% last fall. Now, while those cuts don't directly control mortgage rates, they do influence borrowing costs across the economy. Now, in housing news, existing home closings jumped 5.1% in December, marking a 4th consecutive monthly increase, according to the National Association of Realtors. Sales were also 1.4% higher than a year earlier. Housing inventory fell 18.1% from November to 1.18 million homes, but was still 3.5% higher than last year. Now, new home sales edged down 0.1% from September to October to an annualized pace of 737,000 units, according to data that had been delayed by the government shutdown. Activity stayed near the fastest pace since May of 2023 and above economists' expectations, reflecting contracts signed when mortgage rates were easing. So what do you need to pay attention to? The supply of move-in ready homes remains limited. Of 488,000 new homes available at the end of October, one of the highest levels since 2007, only 122,000 were completed and ready for immediate occupancy. Most inventory is still under construction or not yet started, highlighting the ongoing shortage of finished homes. This week will be relatively busy as we continue to get delayed data reports from the government shutdown from last fall. It will be important to watch how this week plays out as bond and treasury markets have negative trending momentum, which could pressure rates to continue to rise as we work to close out January. I'll be in touch next week with an update, but for now, have a great rest of your day.